Welcome back to the Deep Dive, your essential 15-minute briefing on everything happening in digital assets. And looking at the data today, the market is really sitting right on a knife's edge.
It absolutely is. You've got this really striking divergence. I mean, on one hand, you see these huge, undeniable signs of institutional integration, big capital inflows.
Right.
But on the other hand, you've got sentiment hitting extreme fear territory among retail, and, some veteran holders are actually selling quite aggressively, taking profits.
So these forces are just clashing right now, and the battleground seems to be, well, a very specific price point.
Exactly. That's why our mission today is sort of navigate that contradiction for you. Why is Bitcoin stuck consolidating around that, $107,600 support zone?
Yeah, especially when we just saw institutions pour money back in, and even the Fed seems to be taking steps towards a kind of regulatory embrace.
It's a puzzle.
Yeah.
So let's unpack it. Maybe start with the long-term picture, the structural stuff coming out of Washington.
Good idea, because that Fed news seems foundational.
It really is. I think the most profound development, looking at our sources today, it's this signal coming directly from the U.S. Federal Reserve. Their whole posture seems to have shifted, like from caution to, deliberate integration.
And this revolves around Governor Chris Waller's proposal, the Skinny Master account. Sounds technical, but you're saying this is a big deal.
It's potentially a massive long-term shift, yeah?
Yeah.
Governor Waller basically proposed creating this new kind of limited access or Skinny Master account.
Okay.
Historically, only traditional banks could get direct access to the Fed's main payment systems. This new idea, this framework, it's designed to legally give that same kind of direct access to non-bank institutions.
Non-banks, so like fintechs, stablecoin issuers, crypto payment companies getting a direct line to the Fed.
Exactly right. Think about it like this. For ages, crypto firms needed traditional banks, almost like bouncers, the bridge to the U.S. financial system. This proposal is basically the Fed saying, okay, eligible crypto institutions, here's your own front door key.
Okay, that analogy makes it crystal clear. So they get their own key. Why is that so good for the system overall? What's the benefit?
Well, it tackles efficiency and systemic risk together. Relying on those intermediary banks, it adds cost, it adds friction, delays.
Yeah.
And maybe more importantly, it kind of bundles up risk inside the traditional banking sector. By allowing direct access, the Fed can potentially speed things up, make transactions cheaper, and crucially, it helps reduce that long-term systemic risk. It gives these firms a regulated path to legitimacy.
That sounds really compelling. But, if the Fed's letting these non-traditional players directly into its core plumbing, doesn't that create new risks for the Fed itself?
That's a fair question. And the proposal seems focused on managing that, partly by defining the access as limited.
Yeah.
But look at the context here. This idea came up during the Payments Innovation Conference.
Right, I saw that.
You had leaders there from BlackRock, Coinbase, Chainlink, talking future finance, tokenization, stablecoins.
Yeah.
The Fed is clearly seeing blockchain not as some fringe thing, but as like essential future infrastructure they need to figure out how to work with.
Okay, so this regulatory tailwind, this potential integration, it seems like it might have already sparked a reaction from institutions. Because yesterday, capital flows reversed pretty dramatically.
Okay, absolutely. The taps just turned back on hard. After 4 straight days where money was leaving Bitcoin ETFs.
Yeah, saw those outflows.
On October 21st, boom, a total daily net inflow of $477.2 million into the U.S. spot Bitcoin ETFs. That's a really sharp turnaround in institutional mood.
And it wasn't just one fund trying to prop things up, was it? It looked pretty broad.
It was definitely broad-based. BlackRock's IBIT, they led with about $211 million. But ARK and 21 Shares ARKB pulled in almost $163 million, too.
Wow.
And trading volume across all of them stayed high, like $7.4 billion. It suggests there's still this deep institutional conviction, despite the price wobbling around.
Okay, but here's the detail that really caught my eye, the one that sort of ties this together. This big inflow happened exactly as gold was selling off hard. Tell us about this gold-Bitcoin rotation idea.
Yeah, the timing is just fascinating, isn't it? The same day, Bitcoin ETFs hoover up nearly $500 million. Spot gold prices plummet 5.9%.
Which is huge for gold?
It's the biggest one-day drop since 2020. And market analysts are saying, look, this probably isn't a coincidence. They're suggesting it's an explicit capital rotation.
So the theory is institutions are actually selling gold positions to fund Bitcoin purchases. They're seeing Bitcoin as the better store of value now, the digital version.
That's the thesis gaining traction, yeah. It implies Bitcoin isn't just pulling in new money anymore. It's actively competing with gold for that established store of value capital and maybe winning some of it.
Hmm.
I mean, I know fund managers who'd have laughed you out of the room a year ago for suggesting that. But the data, well, it's making a case. Some are calling it an aggressive catch-up trade for Bitcoin.
If that rotation is real and sustained, I mean, that fundamentally changes the potential market size for Bitcoin, doesn't it? Is the global plumbing, the infrastructure, ready for that kind of shift?
It seems to be getting there. The institutional gateways are opening up globally.
Ah.
Look at Standard Chartered in Hong Kong. They're launching virtual asset ETF trading next month. Why? Because 75% of their clients ask for it.
75%?
Yeah. And meanwhile, Japan's FSA, their financial regulator, they're looking at reforms too, possibly letting Japanese banks hold crypto like Bitcoin for investment. The rails are definitely being laid.
Okay, so that's the big picture. Long-term, fundamentally positive, backed by serious money and regulatory shifts. But if the long game looks that good, why does the short game feel so anxious? This is the conflict, right? Playing out right on the price chart.
That is absolutely the contradiction we have to grapple with right now. Bitcoin's just consolidating really tightly around $107,800. It tried to push past $114,000 resistance, failed, and now it's back defending that $107,600 support zone, which is technically pretty important.
And the volume isn't helping.
No. What's a bit concerning right now is the negative volume balance. Basically, selling pressure is currently outpacing buying demand at these levels.
And that weakness, that pressure, it's showing up in the market mood too. The fear and greed index, it's not looking pretty.
No, it's plummeted down to like 22, 25. That puts us squarely in extreme fear. Now, that sounds bad, obviously.
Right.
But we also know, historically, that level of extreme fear can sometimes mean sellers are getting exhausted. It can be a contrarian signal.
Okay, so you've got this extreme pessimism, but technically the market looks maybe oversold. Like the RSI, the relative strength index, is below 30.
Exactly. So technically, you could argue it's maybe ripe for a bounce, for a reversal, but it needs some kind of spark, right? An emotional shift or some good news.
And this tension is leading to some wild predictions out there.
Oh, yeah. Completely conflicting commentary. You've got respected chartists like Peter Brandt drawing bearish parallels, comparing this chart pattern to the 1970s soybean bubble, which collapsed massively.
Oh, it's soybean bubble.
Yeah. But then on the other side, you have macro optimists, like Eric Trump apparently, predicting $200,000 Bitcoin sooner than expected, pointing to money supply expansion. It's like an ideological battleground at $107,800.
So where's the actual selling pressure coming from then? If institutions are buying, who's selling?
Well, the on-chain data gives us a clue, and it shows this kind of internal conflict, really, between different groups of experienced holders.
Okay, tell us about that. The LTH distribution. Who are LTHs and what are they doing?
Right, LTHs, long-term holders. These are wallets that haven't moved their Bitcoin for over 155 days. So think of them as the veterans, the strong hands.
Yep.
Since about October 15th, they've actually been in net distribution. They've sold around 28,000 BTC net.
Wow, 28,000 BTC. So the veterans are selling. Why?
Likely profit-taking. These are investors who probably bought much, much lower. They're seeing prices consolidate near recent highs, maybe getting a bit nervous about the short term and deciding to lock in some significant gains. It's rational, but it creates this supply headwind we have to push through.
Okay, so the veterans are distributing, taking profit. But who's soaking that up? Is it just the ETF inflows covering that selling?
It seems to be a mix. The ETF inflows help, definitely.
Yeah.
But we're also seeing on-chain evidence that a specific group of large holders, whales, they're actually opening new, pretty large, long positions right now.
Ah, so some whales see this dip, maybe caused by LTH selling, as a buying opportunity.
That appears to be the case. They're stepping in. And there's another interesting behavioral shift happening, too. After that recent big liquidation event we had, traders seem to be pulling back a bit from the really high leverage derivative bets. We're seeing spot market volumes stabilizing, though still quite high, on exchanges like Binance. Maybe $5 billion to $10 billion daily. Suggests a bit more mature trading, less pure leverage gambling.
Okay, that makes sense. Let's zoom out again quickly. The macro environment still feels uncertain, right? Geopolitics hanging over everything.
Yeah, that's definitely still a factor. The whole U.S.-China trade situation is an overhang. President Trump confirmed he's meeting President Xi in South Korea in a couple of weeks, which, could de-risk things a bit.
Could be positive.
Could be. But then you still have the threat of these massive tariffs, potentially up to 155% on Chinese goods, kicking in November 1st. So that keeps the lid on global risk appetite generally.
But despite those jitters, we keep seeing signs that crypto's real-world use is growing. It's not just speculation anymore.
Absolutely. I mean, look at Beal's. That's a 110-year-old U.S. retail chain, 660 stores. They just announced they're going to start accepting crypto payments. That's Main Street saying, okay, this is real.
Yeah, that's a significant name.
And on the infrastructure side, you see things like TRM Labs partnering with Singapore's cybersecurity agency, using AI tools to track illicit crypto flows. That shows blockchain tech getting integrated into, like, national security frameworks. Serious stuff.
It's definitely maturing, but we should probably also acknowledge not every project makes it, right? There's still significant risk in this space.
Oh, absolutely. We got a very stark reminder of that just recently. The Kadena blockchain project announced it's winding down operations.
Oof.
Yeah. And their token, KDA, dropped like 60% on the news. It's a necessary reality check. While Bitcoin and the core infrastructure are maturing, there's still huge idiosyncratic risk out there with many individual altcoins. The market's getting better at sorting the wheat from the chaff, but yeah, risks remain.
Okay, so let's bring it all together. For you, the listener, trying to make sense of this. There's deep conflict between the positive long-term news and this really fearful short-term price action. What's the bottom line?
I think the key takeaway is that the market's fundamental health seems to be improving, even if the price chart looks weak right now. Those positive structural shifts we talked about, the potential Fed integration, the institutional ETF money coming back, they're laying the groundwork for the next phase of adoption.
And the current weakness, the price struggling around 107K, that seems driven by more temporary things. Geopolitical nerves, retail fear, and maybe necessary profit-taking from early investors.
Exactly. So if you're a tactical trader, that $107,600 support zone is everything right now. Watch it closely. If it breaks convincingly, look out below towards $106,000, maybe even lower.
But for the long-term investor,
For the long-term investor, that structural story, especially the reduction in systemic risk hinted at by the Fed proposal, it suggests that these dips, these periods of fear, might actually be strategic opportunities to add to your core positions, assuming your thesis remains intact.
right. So looking ahead, say the next 24, 48 hours, what are the key signals you'd be watching to see who's winning this tug of war?
Okay, three things. First, obviously, defense of that $107,600 level. We need to see buyers step in there. Second, watch the ETF flow data for October 22nd when it comes out. Another day of solid net inflows would really help confirm that institutional reversal wasn't just a one-day blip.
And third,
Just keep an eye on any new rhetoric around U.S.-China trade. Any escalation there could spook markets again. Any calming words could provide relief.
got it. The detail I keep circling back to is that gold-Bitcoin rotation. If ETF inflows really did pick up right as gold had its worst day in years, and analysts are seriously calling it an aggressive catch-up trade,
Yeah.
it means Bitcoin is now genuinely competing for that global store value pot of capital. So here's the final thought to leave you with. Gold's market cap is somewhere around, $14 trillion. If Bitcoin is truly competing with gold now, what percentage, what tiny slice of that $14 trillion needs to rotate into Bitcoin to make those big price targets, 200K, even $1 million seem plausible? That ratio, that potential shift, maybe that's what this is ultimately all about now.